Okay, good afternoon and welcome to our second series of live webinars. During the second series, we continue to explore some of the challenges faced by the investment industry. We will inspire you how behavioral tech helps in digitally converting your die-hard savers into investors, retaining your savers, and rejuvenating your client base. I'm Laurent Lamblin and will be your host today. I'm thrilled today to announce actually that we have Professor Alessandro Previtero as our speaker today. He is an associate professor of finance at Indiana University's Kelley School of Business, and his areas of expertise are, among others, behavioral finance, household finance, and corporate finance. He holds a PhD in management from Salento University in Italy and a postdoctoral fellowship of UCLA Anderson School of Management. He has made numerous academic publications, of which several have won prestigious awards. Today's session will focus on the financial advisors and investor behavior. We all know how access to investments is becoming increasingly democratized for retail investors thanks to the rise of digital. But many retail investors fall prey to behavioral biases and make poor investment decisions. In principle, financial advisors can help their clients navigate complex savings and investment decisions, but do they? Do financial advisors help their clients to achieve better performance? Do they minimize their investment biases? And what are the major benefits of having a financial advisor? During this webinar, Professor Previtero will explore these questions based on the findings from 3 of his most recent publications. I'm sure that we will all get inspired by these findings, as the answers to these questions could have profound welfare implications, not only for households, but also for the investment industry. After Alessandro's session, we will take time for some questions. So please do not hesitate to put your questions, comments, feedback, or share your thoughts in the chat. And you will have the time during the presentation to put your questions there. We will certainly come back to them and have Professor Previtero answer them. So let me invite Alessandro to take over the screen for the next 40 to 45 minutes. Alessandro, good morning, and the screen is all yours.
Thanks, Laurent. Thanks, everybody, for joining. Let me start sharing my screen, and then we are ready to go. Okay, so it's a pleasure to be here. I will be discussing my research looking at financial advisors, and we have 3 papers that try to point out a few of the key things we've learned about financial advisors. This is joint work with a group of co-authors from University of Western Ontario in Canada to Dartmouth College in the US. So study financial advisor, I tend to think that this is a bit of the elephant in the room when it gets to understanding investment decisions. Because we tend to think that households make decisions on their own, but that's not the case. For example, we know that in the US, 50% of the households tend to make transactions using financial advisor. And in Canada, 80% of the retail assets are transacted using financial advisors. We have also data from different studies that were conducted in Germany, where the number is somewhere between 60 and 70%. So half of the population, at least half of the population, don't make investment on their own. They rely on financial advisors. So advisor might add value because deciding how to invest is a complicated problem. I don't have to spend much time on this, but also advisor might help clients dealing with the volatility of financial markets. There is this idea that advisor might provide a bit of the hand-holding needed for people to be in the market. So there is room for advisor to add value. On the other end, though, advisor tends to be remunerated on commission on the product they sell. And so this might generate conflict of interest. And the market for financial advice might be opaque enough that clients might not be able to assess the value of financial advice and hence stay advised even if they're not getting much value. So how do we contribute to this literature? Basically, in the first step that we do, we try to ask two fundamental questions. First one is, if I look at the riskiness of an investor portfolio, what are the effects of the advisors and what drives this effect? And then we are going to look at performance. How well do advised portfolio? So let me just give you a preview of our findings in our first paper. Do advisors customize clients' portfolio? The answer here is yes, but modestly, meaning that aside from clients' characteristics that do matter, advisor characteristics seems to matter more to the resulting portfolio the clients have. Do advisors deliver superior performance? No, we find that advised portfolio tends to lag, the market by the value of the fees, and so that's kind of the setup. So let me now tell you what type of data we have here. We can use a large sample of advisor clients, and let me actually go straight to the data. We have data on 6,000 financial advisors, all their customers, over 500,000 customers. Those advisors work for 3 independent mutual fund dealers. So imagine 3 financial institutions that sell mutual funds. They are pure dealers, so they are not the ones that originated the funds, but they deal the funds. They sell it through financial advisors. So you have 6,000 advisors, over 500,000 clients. And this is a sizable fraction of this entire segment for the Canadian market, depending on the sample cutoff, between 6 and 10%. We get to see a lot of information about the clients, pretty much everything the clients tell to advisors. So let me just give you a sense of the data. I'm going to be describing the data now, and the data will be the same across the 3 papers. Average age is roughly speaking 51 years. Half of the clients are women. The relationship with the advisor on average is 5 years. The account value is roughly 68,000 Canadian dollars, but you can see this is very skewed. And what do we find is that 70%, 69% of the assets are invested in equity. Okay. So what are the information we get to observe? We get to observe whether the account is a brokerage account or a retirement savings account or education college account. We get to observe the net worth, the salary, the risk tolerance of the clients, because they have to address this and answer a survey for the financial advisor. We get to see the level of financial knowledge and the time horizon. So I'm not going to focus on the numbers per se here. This is just a way of telling you how rich the data we are and how many things we can control for. In terms of the advisor, again, tend to have 75 clients on average, a very skewed distribution, and tend to manage $5 million, again, average number. We have 5,920 advisors. The average compensation they earn is somewhere between 50,000 and 80,000. Okay, so first question, what determines riskiness of the portfolio? You might be familiar with all theories of portfolio choices. For example, risk aversion might be a driver, age, labor income, beliefs about asset returns. And so what we do is we try to explain from the data why some clients have 10% of their investment in equities and why other clients have 90%. Okay. And so what you find here, it's basically a regression where we control for all the variables I described before: the gender, the risk tolerance, the time horizon, the financial knowledge. I'm just going to comment on the number in a moment. The salary, the net worth, whether or not you are employed in the financial profession, whether you are self-employed. Long story short, when you run this regression, your R-squared is 13.1%, meaning you can explain only 13% of the variation across choices. And it's a fairly rich, as I made the point, as a fairly rich sets of control variables. Now, what happens if we add just one single information, who your advisor is? You see here in blue, the R squared jumps from 13% to 31.6%, 32%. So the way you want to think of this, it's the first key takeaway here is that financial advisors matter a lot in determining what clients have in their portfolio, more so than who the clients are, the client's preferences, the client's income, their wealth. So of course, advisors have this effect, but this effect is not constant for everybody, meaning that some advisor on the right-hand side here might recommend very risky portfolio. Some advisor on the left-hand side might recommend more conservative portfolio. And so what we are after is try to understand what really explain this variation in advisor effect that you see here looks like a normal distribution. So we take this advisor effect and we regress these on observable advisor characteristics. And so let me just skip this in the interest of time. And so what do we find here is that when we account for advisor and investor fixed effect, we can still find that the effect of advisor is very strong, okay? So the way to think about this is that a potential concern that you might have in the back of your mind is that clients select advisors. And by client selecting advisor, I mean that, you know, if I like risk investment, I might be more drawn towards joining an advisor who likes to take more risk. And so what might be capturing in the R square of 31% that I showed you before is the fact that I pair with advisors that share similar preferences that are not captured by my control variable. So they end up being captured by the identity of the advisor, some unobservable variable to us as econometrician. To address this issue, what we do is we look at a sample of clients that switch advisor because the advisor leave the market. The advisor dies or retires, so these are not switches that are initiated by the clients. And so in doing so, we can technically do a more refined estimation where we control not only for the effect of the advisor, but we can control for unobserved characteristics of the clients. So technically, we can have in the same regression, advisor fixed effects and investor fixed effects. The way you want to think about this in terms of a thought experiment is that what happens when a group of clients get transferred to another advisor that's not the advisor originally shared? Do I still find that the advisor affect their decisions? And the answer is yes. And this is comforting because it means that we are not really capturing these endogenous matching, this matching between advisor and clients across unobservable characteristics. So what explains advisor effect? That's kind of what we are after. I show you that there is this variation in advisor effect. And so what we do, we can regress these advisor effect on characteristics of the, we can regress the advisor effects on characteristics of the advisor. The key feature of our data is that we also observe how the advisor themselves invest. Hence, in a regression, we can actually account for what the preference that advisor have as shown in their own portfolio. And surely enough, what do we find here? Let's focus for a moment just on column one. We are regressing the advisor effect on determining the riskiness of the portfolio on, for example, the age of the advisor, the gender of the advisor. And you see at the bottom, we get a very modest R square of 2.7%. But when we account for the advisor on riskiness of the portfolio, in red here, called advisor risky share, the R square jumps up to 15%. So what this is telling us is the fact that some advisors tend to make more conservative recommendation or riskier recommendation doesn't really depend on whether the advisor is a male or female, is young, old, the income of the advisor. It depends much more on what the advisor do in their own personal portfolios. First kind of sum up, first results, advisor drives client's portfolio. And what feature of the advisor drives client portfolio is what do they do in their own personal portfolio. And then we investigate what are the effects on performance. And so do advisor deliver? They don't seem to be customizing a lot. They seem to have their preference prevail. do they at least happen to deliver higher returns? And so what we do here is we do a simple alpha computation. As a benchmark, we have a one-factor model. So think of this as basically the returns of the advised portfolio versus the market. And then we have a six-factor model where we have equity and fixed income factors. And so what do we find is that gross of fees, the alpha is pretty much zero. So it's depends whether we do value weighted, there will be the average dollar, or whether we do an equally weighted, there will be the average advisor. But you can see is from -16 to +10 basis points, but these are not statistically significant. What happens net of fees? Net of fees, you find that advised portfolio lag the market by 245 to 300 basis points, depending on how we aggregate the measures. And the results, if anything, becomes worse when we account for more factors. So what is the way of kind of thinking about this? Is that the cost of advice seems to be around 2.5%, 2.67%. And if you want to have a fair benchmark, because Canadian funds tend to be expensive, a fair benchmark would be to say, what would cost to have the clients invested in a life cycle fund? And Canadian life cycle funds charge 1% a year. And so the idea is that basically the average Canadian investor give up this 1.7% a year relative to a reasonable passive investment benchmark. So first analysis, first paper, what's the conclusion? Do advisors tailor their portfolio to customer characteristics? Yes, but to some extent, their own personal preference seems to be driving portfolio way more. Do these investment advice create value? The answer would be no, because we don't have evidence of gross alpha. If anything, net alphas, net of fees are negative, equal to -270 basis points, -170 if we compare this to another reasonable benchmark, such as life cycle funds. Okay. Then we took a step in trying to understand the effect of advisors on client biases and investment mistakes. That's the second paper I will be discussing. And so, we have already discussed this idea that investors are paying 1.5 to 2.5 more for advised. And if you compound this might be equal to 15 to 25% reduction in retirement assets over 30 years. So that's a pretty sizable cost that advisors are getting. And so one reason why advised could be of low quality, it's conflict of interest. Is this idea that advisors earn commission on what they sell, hence they might sway customers towards the hot funds, the expensive funds, they may trade them a lot to maximize their fees. As a matter of fact, for example, UK and Australia have banned commission-based compensation. And in other countries like the US, for example, there is the fiduciary duty is being discussed as a way of making sure that advisors act in clients' best interest. What do we do in this paper is we try to provide evidence or investigate an alternative hypothesis. We call this misguided beliefs. And the notion is that clients make investment mistakes. They get not great recommendation, not because the advisor are these strategic crooks that try to maximize profits, but because advisors don't know better. So advisors make recommendation on buy the actively managed funds, the hot funds, the expensive funds, because they genuinely believe that those funds would earn higher returns. So how we can distinguish whether advisors are strategic or not? Again, the richness of the data here helps because we get to observe advisor own portfolio. And so we can compare how advisor invest their own money versus how client invest money following advisor recommendation. And what do we find is that client and advisor both under diversified, chase return, invest in high cost, actively managed funds, and they earn similar negative net returns, the one that I showed you before. And so the idea here is that, the personal belief of the advisor once again seems to be driving client asset allocation, an advisor give low quality recommendation because they have the wrong beliefs to begin with. So let me show you some data to prove this. So what we have here is a series of behavior that we measure in the data from actual transaction. These will be defined as investment mistakes, generally speaking. So return chasing means that you tend to buy the funds that have performed well in the past. So clients tend to buy funds that are at the 60th percentile, so above median of past performance. 98.5% of the funds they own, they are actively managed. Their turnover is fairly high, both in retirement accounts and in brokerage accounts. It's more than 30%. And they tend to under-diversify. We have a measure here of the idiosyncratic volatility of their portfolio. They tend to have high idiosyncratic volatility, 7.3% a year. In terms of fees, they end up paying 2.36% a year. So let's just look and see what do we find when we look at the advisor. And surely enough, what you find is the advisor, if anything, seems to be doing more of the same in terms of having the wrong behavior. They buy hot funds, invest mostly in active manage. For example, look at turnover. In open accounts, the turnover of advisor is even higher to the turnover of the clients. They have a higher idiosyncratic volatility. And in terms of fees, they seems to pay, if anything, they buy more expensive funds. The average fee, the average management expense ratio, sorry, that they pay is 243 basis points versus 236 from the client. Okay, so we have evidence that we look at the portfolio of the advisor, they seems to be making the same mistakes that clients make. Let's just provide some additional evidence, try to crystallize this idea that indeed clients are swayed by advisor in the wrong direction. Okay, so as you can see here, we are looking, for example, a variation in return chasing. You're going to have the clients are in white and the advisor are in the dark color. Again, there is a huge variation. So some clients tend to buy hot funds, they will be on the right. Some clients tend to be contrarian, they will be on the left. And you see, you get a similar distribution for advisors. If anything, distribution of advisors seems to be more skewed towards the hot performing funds. Okay. And so what do we want to do is a regression similar to the one we've run before. For each of these investment mistakes, we are going to say, first of all, whether or not we can explain the mistakes using investor characteristics. Then we are going to look at whether or not advisor effects are important. And then we're going to try to explain advisor effects using advisor characteristics and advisor own choices in their own portfolio. And you already give up the answer, you know we're going to find very similar results. So let me go step by step. What you have here are the R square. So each number here is an R square from a specific regression. For example, if we look at return chasing by the hot funds, and we only look at what clients, sorry, this skipped, and we only look at clients, we are going to find that we can explain 5.1% of the variation, again, looking at clients and observe heterogeneity, client fixed effect in practice. Once we have advisor fixed effects, you see that the advisor fixed effects are stronger, and they account for 19.7% of the variation. And so for all behavior, I want you to notice that the client fixed effects are significant, but the advisor fixed effects are as significant, if not more significant in specification. And so we can basically conclude that the identity of the advisor matter at least as much as who the client is in determining those investment mistakes. And then we run the regression that we ran before. Now what we're trying to say is the behavior fixed effect. So the fixed effects associated with, for example, high turnover, we try to explain these with a series of control, information demographics about the advisor, but also whether or not the advisor has high turnover in the portfolio. And what you find is that for all the behavior, we find a positive correlation. And these are all statistically significant correlation as highlighted by the high T value. So for example, return chasing in the advisor own portfolio predicts return chasing in the client portfolio. Active management in the client, sorry, this is skipping. Active management in the client in the advisor portfolio predicts active management in the client portfolio. So we then take very seriously the possibility that advisors are very strategic, meaning they buy the hot expensive funds only to have an easier time selling the same hot expensive funds to clients, not because they really believe that's the best thing to do. You know, it might be a problem of cognitive dissonance for those of you who are kind of more expert in terms of psychology. But in a nutshell, advisor, you know, would feel bad in buying one thing and trying to sell something else. So if they're very strategic, it might make sense for them to buy investments that or funds that underperform in their own personal portfolio, as long as these allow them to maximize fees. And that's we call this window dressing. Basically, this idea that they are going to do this just to make them the investment they're proposing look better. And so we take seriously this explanation, and we have a way of testing and ruling out this explanation. The basic idea is once an advisor stops working, they don't have an incentive anymore to sell these hot expensive funds. And so if they were doing this just to trick, pass me the term, or fool their clients, then when they stop working and they're not advising clients anymore, they should start buying the funds that are the best in terms of performance. And so what we do here, we compare the advisor in terms of this behavior, when they chase, when they are active, and when they stop working. Those are the same advisor. And so, for example, if you look at many of these behavior remain substantially high. After stop working, they still have return chasing. Sorry, this is going back and forth. They have return chasing. They tend to buy actively managed funds. They have high turnover. For example, look at the turnover here. On average, is 53.4%. Before, when they were active, was 35%. And even in terms of fees, the fees they pay is still 233 basis points. Okay. So we seem to have evidence that even when they stop working, advisors still buy hot, expensive, actively managed funds that do not deliver performance. So let's just try to give you a sense of how much these misguided beliefs might weight in terms of performance. And so what we do here, we do an exercise in this sample where we look at the alpha of the clients, the alpha of the advisor, and then we just do a very simple exercise where we say, you know, the advisor alpha would reflect the fact that advisor gets rebates on the funds they buy, because basically they don't pay commission to themselves. Okay. And so if you look at the client with fees, we are going to find that they lag the market by 322 basis points. If we look at the advisor, accounting for the fact that they have fees and rebate, they seems to be lagging the market by 300 basis points. So they do relatively better. But then we compute this hypothetical portfolio. Basically what we do here, we say, okay, for each advisor, we are going to force them to hold a value-weighted portfolio of all their clients' assets. So what if any advisor could not deviate from their clients' holdings? We just give them their clients' holding. Would they do better? And what you find is this hypothetical portfolio would underperform the markets by 226 basis points, which, by the way, it's 75 basis points better than what advisors do in reality. So if you do this exercise where we say, we are going to change the advisor, force the advisor to hold their client's portfolio, you will be increasing their performance by 75 basis points a year. And we also do some more refined analysis. Basically, what you find is that when advisor and clients deviate in terms of holdings, what the advisor buy that's unique to what the advisor buy is actually, those are actually the funds that have the worst underperformance. One last exercise that we do is basically we split the advisor alpha in 10 groups. Number 10 are the advisors that have the best performance on their personal portfolio. Number 1 are the advisors that have the worst performance. And then we ask on the y-axis, what happens to the client alpha? You see, it doesn't matter if we look at gross or net. Basically, if you are paired with the advisor who has the worst performance, and you are able to switch to the advisor who has the best performance, client will get a 1.6% higher return a year, which we deems to be pretty sizable. Okay, so what do we learn from this second exercise? We learned that, do advisors help clients mitigate biases? Unfortunately, the answer is no. Advice portfolios share many of the biases that a retail investor on their own have. The silver lining, though, is that advisors don't seem to sway clients towards worst performance and higher investment biases because they are strategic about that. We tend to believe that advisors have the wrong beliefs to begin with, as is illustrated by the fact that they also tend to buy the expensive hot funds in their own personal portfolio. And if anything, advisors tend to underperform in their own personal portfolio what their clients do. Okay. We are kind of at this point, we, after I've done 2 research paper, we were wondering, why do clients stick with advisors? Because, they don't get a lot of customization. It's very costly, and advisors don't seem to correct the biases. And so we were left with a bit of this puzzle. Advice is very prevalent, but people don't seem to be getting high benefits from it. And so this is what we investigate in this third paper. And so we entertain and test seriously for the idea that maybe what advisors provide is a hand-holding that allow clients to be in the markets in the first place. You might think of this idea that there is a lot of anxiety in investing in the stock market because of volatility, but if you have a financial advisor, the financial advisor can reduce this anxiety. And basically, what clients pay with this low performance, it's this hand-holding that they're gonna get from the advisor, okay? And now, although this is a straightforward idea, it's very tricky to test empirically because, there is a huge selection effect. The idea that, clients choose advisors, and clients might choose to be advised exactly because they want to invest in the stock market or they want to take financial risk. And so, it's not advisors that facilitate financial risk, it's clients that they're going to take financial risk that are more likely to hook up with a financial advisor. How do we solve this selection issue, which is indeed it's a bit of the old dichotomy between correlation and causation. We look at a regulatory change that happened in Canada, and we can infer from that having a financial advisor has a causal effect on increasing stock market participation. After looking this at the survey level, we move to our transaction level data that I've illustrated in the previous 2 papers. And we try to see whether we find evidence that trust between the clients and the advisor matter. We proxy for trust looking at the length of the advisor-client's relationship. And what do we find is that the longer you are with the advisor, the more likely you are to have riskier investments. And we also find that over time, as the length of the relationship increase, investors become less sensitive to past performance, and they are more likely to stick with the advisor even in turbulent time. We have evidence from the great financial crisis. Okay, so let me go into the details of the results of the data here. So what is the effect of advisor on clients' risk-taking? Do advisor foster, encourage stock market participation? We use survey data, Canadian Financial Monitor data. This is a survey done to Canadian households, 1,000 households every month. Important, we know whether or not the clients are advised. 40% have financial advisor, 60% are unadvised. As you might expect, there is a huge selection here because advised clients tend to have higher income, more financial assets, they are more educated and more likely to be homeowners. And you see You see it here. The advised clients have lower age, they have higher income and higher financial assets. So how do we account for the fact that the demand for financial advice is something endogenous, and clients might decide to have a financial advisor exactly because they intend to invest in the stock market? We use this regulatory change that happened in many Canadian provinces, except that in Quebec. What the regulatory change did was something akin to what the MiFID II has done in Europe, but basically impose a series of registration requirements. So if you were a financial advisory firm, you had to register with a regulatory body. You have to face compliance costs. You have to train your advisor. You have to survey the clients using specific forms, and you have to have capital requirements. So long story short, think of this as a negative shock to the supply of advisor. If you make being an advisor costlier, you would expect that the number of advisors would go down. And that's what we find. The number of advisors fell down from 100,000 to, roughly speaking, 81,000. Why this is good? Because now we have this shock to the supply that is not driven by the demand from advice. And so the thought experiment we're going to do is basically we will be asking, once there is regulation and there are fewer advisors around, is it true that I see fewer people participating in the stock market? If that's the case, then we can conclude that financial advisor has a causal effect on stock market participation of clients. Okay. So in practice, we run a diff in diff between Ontario, for example, and Quebec, where the regulatory change did not happen. And then we use these in a two-stage least square to estimate the effect of using financial advisor. Let me show you the first results. Is it true that after the regulatory change, the probability of having a financial advisor goes down? That's the first row you see here. In fact, the probability goes down by, for example, look in column 2, 4.2 percentage points. That's roughly speaking 10% of the mean of using advisor. So yes, we do find evidence that in provinces where they pass the regulation, people are less likely to become advised. Then we can use these to estimate the effect of advisor on stock market participation. And so what I want you to focus is the stock market participation here and the column where we have the IV estimates. And so what you find here is that having a financial advisor increase the probability of participating in the stock market by 59.2 percentage points. Okay, it's a very strong effect. Now, it's important though, if we compare the naive estimation, the OLS estimation, we have a coefficient that's positive but smaller. This tells us that the people that are more likely to hook up with a financial advisors are the ones that, if left on their own, they would not be participating in the stock market. So actually the selection go in the opposite direction of what we originally thought. Okay, so let me use the last 5 minutes or so to provide evidence that trust is what's driving this increased willingness of taking risk. And so what do we do here? It's basically, we look at this notion of trust. Let me actually go straight to the graphs and that kind of explain the story. What you have on the x-axis is how long a client has been with a financial advisor. And you go from 0 to 120 months, 10 years. On the y-axis, we have the riskiness of your portfolio. And so let's start with the red line. The red line is the full sample of investor without any selection. And so what you find here is that linearly, as tenure with the advisor increase, also your share of risky assets increase. The blue line basically capture the fact that we exclude those advisors that were at 0 or 100%, so they cannot mechanically go anywhere. Okay. So a way of thinking about this is, let's look at column 2 just for a moment here, is that, when we control for the same client, the same advisor in the same month, when we control for the same advisor in the same month, we can simply look and say, okay, What do the clients that have been with this advisor the shortest do in terms of risk taking? What do the clients that have been the longest do in terms of risk taking? And surely enough, when you go from the lowest tenure to the highest tenure, you see that in all specification, the share of risky assets increase. For example, in column 2 goes from 2.5% to 7.3%. And again, this is a very neat setting because we are keeping constant the same advisor during the same month. So we are controlling for a lot of things, advisor view, market condition. We are just using variation in terms of how long clients have been with the advisor. And the clients that have been the longest, they tend to take more risk. Okay, so let me give you some sense of what happens to the sensitivity of clients to past performance. So we are going to look at two buckets of clients, the one that have been in the bottom decile of tenure and the one in the top deciles. The bottom deciles, we're going to call them low trust. Those are the ones that have been with the advisor the shortest. The one that we have here in blue, I trust, are the one that have been the longest. So what is the probability of selling risky assets over the prior quarter returns? And what you find is that the blue line is flattened compared to the red line. We know that there is a U shape, meaning that investors tend to sell the investment that do extremely well and the one that do extremely poorly, but the sensitivity becomes a half or less for in clients that have very high tenure. What about buying risky assets? What you find there is after bad performance, the clients that have low trust, low tenure, are less likely to buy risky assets. The clients, the blue line is pretty much flat. When it gets to buying risky assets after good performance, we find that the high trust clients tend to be twice as likely as investing in risky assets. Okay, so this is kind of strong evidence that the advisor seems to reduce with time, and as clients trust more, they reduce the sensitivity of clients to performance. One last data point, we have information on the financial crisis, which was very severe in Canada. You can see here the dark bold line is the drop in the market around 2008, 2009. Also, the risky share of the asset bought by retail investors goes down in Canada. And so we do a very simple exercise. I'm just going to describe this table in the interest of time. We just ask, what happens to two investors, one that have been with the advisor just a few months before the crisis hit, and one that has been very long? Turns out that the one who has been very long is way more likely to remain invested and keep the same advisor. So what is the takeaway from this paper? Having financial advisor actually encourage stock market participation, increase financial risk taking, and reduce the sharing cash. We think that this is driven by trust, as shown by the micro level data, where we do find evidence that as clients stay longer with the advisor, they take on more risk, they become less sensitive to past performance, negative past performance, and they become less likely to quit. Okay, that's all I have. Lorraine, I think you are muted.
I don't think so. I was muted. Thank you very much for sharing those insights. Some were very, very challenging. I had a first question coming in the chat as well by one of the participants. He states that your research challenges the added value of an advisor, or at least puts it in a perspective when it comes to increasing portfolio performance. And he asks us two questions here. The first one is, did you also research how advisors contribute to financial inclusion? Meaning, do advisors contribute to people actually investing? We already saw that they were taking up more shares, more market participation.
Yeah.
But do they actually attract new investors? And then a second question, continuing on that example, do you see examples in Europe or in the United States of technology that adds to financial inclusion and or portfolio performance in a digital way, hence without the advisor?
Yeah. So let me just, I think that the answer to the first question, I think that was asked earlier before I described paper 3. I think it's largely in paper 3, meaning, you know, do advisor encourage participation? We tend to find a strong yes there. And it's interesting, and again, I don't want to go technical, but basically, when you estimate stock market participation on use of advisor, naively, you're gonna get a correlation there. And when you use instruments, you will correct for the bias in the correlation. Okay. And what we thought originally was that people that have a financial advisor, they're going to be more likely to invest on their own. So we are going to overestimate this coefficient. Why? Because some people on their own, they will be doing anyway. When we do our regulatory change correction, which is technically called an instrumental variable correction, we try to go from correlation to causality. We actually find the opposite, which was surprising to us. And the opposite meaning that we do find that if you run the naive regression, you are underestimating the effect of advisor on clients, meaning that those clients that are the ones that are going to be affected by advisor will be the ones that will not invest on their own. So aside from the technicality, I think this is strong evidence that there is out there in the population a group of people that on their own, they don't feel comfortable investing. When advisor comes in and hold their hands, that's when they feel comfortable investing. Okay, so exactly, there is a very, I think, strong evidence from the research we've done that advisors do increase inclusion. So that's in terms of the first question. And let me kind of transition to the second question. And so now, you know, we to what extent this can be replicated using in a digital way.
Yes.
And we also have data from a robo-advisor in Germany, where we do find that using a robo-advisor tend to increase financial risk-taking and tend to increase investment in efficient way. In this case, the robo-advisor actually, you know, put ETFs front, center, and left. And so clients' performance increased dramatically after they joined the robo-advisor. So having said that, though, I think it's there is a big challenge here that we haven't, and something that I cannot answer empirically. The idea is that robo-advisor have proliferated, and they started after the financial crisis, and they proliferated in a market that has been most of the time upward. Okay, so leaving aside the COVID experience, which is kind of a unique experience, and we are trying to get data on the COVID, but we haven't gotten data yet. So this raises the question, how effective are going to be digital tools when there is high volatility and you cannot call anybody, you are left on your own. Yeah. And unfortunately, my sense is that they're going to be less effective in terms of facilitating risk-taking, but I don't have the data to speak to that because we are in the process of getting this data. So we have been, you know, studying robo-advisor. We have data that goes from 2013 to 2017, 18. But then, you know, the first negative shock happened in 2020 with COVID. So we don't have a sense of that. So to sum up, yeah, advisor help participation in a dramatic way, especially for those investors on their own that would not participate. It seems that the robo-advisor can substitute some of these, definitely providing more efficient asset allocation, but we don't know how well those digital technology might do when investors face volatility and they do not have a direct way of interacting with a human being.
Yeah, very clear. I have a more different question. Your research also points out that clients make the same mistake as their advisors. Is that when trust between the advisor and the client is also the highest, because clients tend maybe just to stick or prefer advisors that are most similar to them, and in that matter, in that case, making the most similar mistakes, being open to those mistakes in the first place?
So it's an interesting question. I can tell you what my hunch is because I don't have run this analysis, because we first look at biases and then we look at the length of the relationship. So I guess what you're asking is the propensity to make investment mistakes as much as the advisor do increase with tenure? Okay, that would be the way of phrasing the question. So I think that I would expect yes, because we do find that the willingness of taking risk increases. So then this means that the weight of the advisor recommendation increases. So then if advisor recommend you to take more risk and you do take more risk, then I'm expecting also that advisor would recommend you to buy the hot expensive funds. You're going to be more likely to do that. Having said that, there is though something that, again, we haven't investigated, but is on our research agenda, is trying to understand to what extent advisor pander to client biases. So you have a client that comes and they believe that investing in crypto is a great idea. And you think it's actually not a great idea, but if you shoot them down right away, you might lose the client. So then you might just say, you know what, yeah, it's a great idea, let's do it. Let's do it, with a little bit of money and see how it goes. And then over time, maybe the advisor finds a way of saying, look, maybe we want to move some of these crypto gains into safer investments. And so you see, so then there might be a direction through which this relationship between tenure with the advisor and biases might be non-linear, in the sense that advisor might initially pander to biases to get clients' trust. And when they have clients' trust, they might let their own views to become prevalent.
Yeah. I'm checking if I have other questions coming in the chat. I don't see them immediately. If there are no other questions, maybe I can just end with one humoristic note. I saw that you were referring that the advisors tend to trade even more when they retire. I was kind of surprised. Is it probably because they're getting more bored and have much more time to turn over their own portfolios, or are they missing the action? I was really wondering, because it struck me as quite different from what I would do, I suppose, when I retire myself.
Yeah, there was our interpretation of that finding. But again, I think it's, to put this in perspective, the idea would be, now that you retired, if you know that ETF, passive investing, cheap investments are the way to go, then you don't have a reason anymore to hold those expensive funds, because you're not selling them. And it's interesting because another thing that I did not have time to point out is that when advisors retire, they lose the commissions on what they buy.
Yes.
So for them, all the funds now become more expensive. Before, there is a sticker price, and then there is the price they pay. When they retire, they are paying the sticker price, but nonetheless, they continue to buy a full price, expensive funds.
So there is hope for the banking sector even there.
Yeah.
Okay, I see that there are no other questions. This will then maybe conclude today's session. Thank you very much, Professor Previtero, for your very, very interesting insights that will certainly make our viewers think about and ponder about their own businesses. I also would like to share our next agenda for our next session in March. Professor Milo Bianchi, Professor of Finance at Toulouse School of Management, will go explore how to augment investment decisions, which might help the previous customers of the studies of Mr. Previtero and preserve clients from bad investment decisions. If you want to attend, please do not forget to register on our website at everyoneeinvestor.com/webinars, everyoneeinvestor.com/webinars. Recordings of today's session will be made available later to the attendees. And I would be very, very grateful when leaving that you give us your feedback on today's session, as it will certainly help us to improve future sessions as well. Once again, thank you very much, Alessandro, for your time and being with you, sharing your insights. Thank you very much. And thank you all for joining today's session. Looking forward to seeing you on March 16th. Bye-bye.